earnings conference call. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involves risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mohit Jain, Executive Vice Chairman. Thank you, and over to you, sir.
Good morning and a warm welcome to all of you joining us for the Indo Industries Limited Q4 and FY25 earnings call. I am also joined by our Group CFO, Mr. Muralidharan, Mr. Manish Bhatia, our CFO, and Strategic Growth Advisors, our Investor Relation Advisors. We hope you've had the chance to review the financial results and investor presentation available on the stock exchange and on our company website. I'm happy to share that 20 years ago, we seeded the thought of entering the home textile business. Since then, we have grown to a global leadership position with approximately $500 million in revenue, marking a significant milestone in our journey. FY25 has been truly transformational for our company. We achieved substantial growth, reflecting the continued trust and confidence our customers place in us. We recorded highest ever revenue, reinforcing our leadership position in the global home textile industry. Revenue grew by 16% to approximately 4,200 crore, the highest in the company's history and outperforming the peer group. On the volume front, we surpassed the 100 million meter mark, achieving 106.4 million meters. While this is a marginal shortfall versus our guided range, it represents a healthy 10% year-on-year growth. An important achievement was the improvement in our DJSI score, which increased from 45 in 2023 to 66 in 2024. This positions Indocount among the top 10% in the textile, apparel and luxury goods sector, significantly above the industry average of 30. We also received several ESG-related recognitions during the quarter. Some of them are winner of the Best Sustainable Retail Practices Award, winner of the Excellence in Wastewater Reduction and Circular Innovation Leadership Award, first runner-up in Best Cotton Farming Practice category. On the EBITDA for FY25, we reported EBITDA of rupees 574 crore with a margin of 13.7%. EBITDA margin was slightly lower due to the impact of strategic investments made in our businesses and weaker than expected Q4 performance of our end markets. We will cover the same in our speech in detail. Now coming to Q4 performance. FY25 was a stable and overall positive year for us. However, Q4, particularly February and March, presented significant challenges. We saw a decline in offtake driven by reduced consumer confidence, largely due to uncertainty surrounding potential tariffs. This shift in sentiment altered our product mix, with increased demand skewing towards lower to mid-priced offerings as opposed to our typical sales profile. Across our end customers, we experienced low confidence as they grappled with creating the right assortment of products on the back of potential tariffs and low consumer confidence. This resulted in both volume and value downtrading, which impacted our average selling price by approximately 6% compared to the average of the previous few quarters. This change in product mix affected our Q4 revenue and in turn our profitability due to lower absorption of fixed costs, especially our US business, which is in investment phase. We continue to witness similar volume and value trend in Q1 FY26 and expect subsequent quarters thereon to improve gradually. Given the fluid nature of the current tariff situation, with the 90-day pause period set to conclude by early July, we believe it is prudent to refrain from volume and margin guidance for FY26 at this point of time. We are actively evaluating a broad range of potential scenarios while closely engaging with all our end customers. Our focus remains on maintaining maximum operational flexibility while safeguarding business volumes and ensuring we retain, if not grow, our market share. In this financial year, we embarked on multiple capacity and capability enhancing projects by venturing into new businesses. Our efforts were focused on expanding into value-added segments such as utility and brand building initiatives, a transformation we now refer to as Indo 2.0. I will share some key highlights. 1. We successfully acquired Vamsuta brand in US. This is a legendary home textile brand, and we expect to launch this as a direct-to-consumer brand shortly with a strategic brand positioning in the US market to start with. Our strategy to enhance contribution from licensed brands has gained momentum with the addition of Fieldcrest and Waverly to our portfolio in Q4FY25. Both are well-established consumer brands in the US market. Although it's been only 2 quarters since their inclusion, they are already gaining consumer traction and are expected to support our growth in the US market. 3. The utility bedding segment in the US presents a significant opportunity, representing a $4 billion market within the bedding category. To accelerate our growth and strengthen our presence in this space, we have strategically expanded our manufacturing capabilities for pillows and quilts through targeted acquisitions. The first one being Fluitex, a leading manufacturer of pillows and quilts with an annual revenue potential of $50 million. Second, we did Modern Home Textiles, a specialized pillow manufacturer with an annual revenue potential of $35 million. Both facilities are currently operating at approximately 50% capacity utilization. We expect to gradually ramp up utilization levels over time, which will further enhance operational efficiency and support our efforts to capture a larger share of the US utility bedding market and drive meaningful revenue growth. This encouraging performance of Fluitex and Modern Home Textile has reinforced our confidence in the US utility bedding market and encouraged us to set up a greenfield project in North Carolina focused on pillow manufacturing. The first phase of investment is expected to be completed by September 2025. We expect peak revenue potential from this phase to be at $85 to $90 million. This expansion marks a significant step towards strengthening our manufacturing footprint and accelerating growth in the US market. With these 3 facilities, we'll be able to cater to all the geographies of the US market. 4. Recently, we also acquired a licensed brand, Beauty Rest, from Serta Simmons Bedding, a renowned global sleep company with a 100-year legacy in delivering industry-leading sleep solutions and a commitment to improving lives through better sleep. This strategic partnership is set to harness Indocount's strong manufacturing expertise and expansive distribution network, combined with Beauty Rest's innovative product portfolio. Over the past 12 to 15 months, we have invested approximately 460 crores in brand acquisitions, capacity expansion, brand building, and talent acquisition, thus laying the foundation for a future-ready, diversified product portfolio. These strategic investments will deliver substantial growth, reinforcing the company's path to becoming a dominant industry player. As of FY25, Indocount has achieved revenues of approximately 500 million, and we remain confident and committed to our goal of doubling our revenue by 2028. This growth will be fueled by the full-scale ramp-up of our branded and licensed offerings, optimal utilization of our utility bedding business in the United States, and continued strength in our core bedsheet operations in India. With these initiatives, while these initiatives will secure long-term premium growth there may be a short-term impact on growth and therefore our margins. Despite the challenging environment, we successfully maintained the revenue contribution from each segment for FY25 compared to the previous year. Moreover, in absolute terms, each segment has posted positive year-on-year growth. Coming to industry scenario, one of our most significant recent developments for the textile industry and for us at Indo is the signing of the India-UK Free Trade Agreement. This agreement eliminates duties of approximately 10 to 12% on nearly all Indian textile and apparel exports to the UK, making Indian products far more competitive in that market. With this FTA, India is now on an equal footing with countries like Bangladesh and Pakistan, which have long benefited from duty-free access. This landmark agreement is expected to significantly boost India's textile exports, with some projections indicating a potential doubling by 2030. As global supply chains increasingly diversify away from China under the China Plus One strategy, India is strategically positioned to capture a larger share of global demand. At Indocount, we are well prepared to capitalize on this emerging opportunity. Currently, the UK market contributes approximately 10% to our overall business. And with the advantage of this trade agreement, we are optimistic about significantly expanding our presence in the region. On the EU front, India is currently engaged in free trade agreement negotiations with the aim of concluding discussions within the next 2 quarters or by the end of this calendar year. If successfully finalized, particularly with favorable terms for our segment, it could unlock significant opportunities for Indian home textile exports by providing a level playing field in the EU market also. This development has the potential to further accelerate our growth. Turning to our largest market, US. Specifically regarding the recent tariff developments, while a 90-day pause has been announced, an additional baseline tariff of 10% is currently in effect for all countries except China. For China, this is compounded by an additional tariff on top of the baseline. While China's direct presence in the bedsheet segment is relatively limited compared to India, the impact on us is more indirect. All major retailers source a significant portion of their overall product range from China. As a result, the additional duties on Chinese imports affect their broader sourcing strategies, which in turn influence their buying behavior across categories. There are encouraging developments on the trade front, with recent reports indicating that India and the US may finalize the first phase of a bilateral trade deal before July this year. We remain optimistic as recent updates suggest that India has been actively advocating for preferential treatment for exports in key labor-intensive sectors, including textiles. Such a development could significantly strengthen the global competitiveness of the Indian textile industry and create new opportunities for growth. As we move into the next financial year, we anticipate short-term demand to be impacted by consumer confidence and overall sourcing strategy of our end customers. From a long-term perspective, we remain optimistic about our growth prospects across our key end markets. That is from my side. Now I request Mr. Muralidharan, our Group CFO, to share the financial highlights of the company.
Good morning to everyone. As for volume, sales volume for Q4 FY25 stood at 25.6 million meters versus 28.7 million meters in Q4 FY24, down by 10.8% year-on-year. Sales volume for FY25 stood at 106.4 million meters versus 96.9 million meters in FY24, a growth of 9.8% year-on-year. Total income of rupees 1,029 crores in Q4 FY25 versus 1,093 crores in Q4 FY24, down by 5.9% year-on-year. Total income of 4,191 crores in FY25 versus 3,601 crores in FY24, a growth of 16.4% year-on-year. EBITDA for Q4 FY25 stood at 88 crores versus 166 crores in Q4 FY24, lower by 47% year-on-year. The Q4 impact on EBITDA was on account of lower sales due to weak market demand, as alluded in our opening remarks earlier. EBITDA for FY25 stood at 573 crores versus 603 crores in FY24, marginally lower by 5% year-on-year. EBITDA margin for FY25 stood at 13.7% versus 16.7% in FY24, down by 300 basis. As for PAT for Q4 FY25 stood at 11 crores versus rupees 92 crores in Q4 FY24. PAT for FY25 stood at 246 crores versus rupees 338 crores in FY24. It's important to understand that currently we are in investment phase, which has resulted in higher depreciation and interest costs to the tune of approximately 150 basis points. As we scale our volumes and revenues, we expect better flow through from EBITDA to PAT over the next 2 years. EPS for Q4 FY25 is rupees 0.56. EPS for the whole year FY25 is rupees 12.42. Net debt to equity is 0.42 as on 31st March 2025, as against 0.32 for the previous year. I'm happy to say that the Board of Directors has recommended dividend of rupees 2 per equity share of face value of rupees 2 each. That's 100%, subject to the approval of shareholders at the ensuing annual general meeting. With this, I open the floor for Q&A. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, in order to ensure that the management is able to take questions from all participants in the conference, please restrict yourself to only 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Raman from Sequent Investments. Please go ahead.
Hello, sir. Can you hear me?
Yes, we can hear you.
Sir, my first question is with respect to the phase 1 in North Carolina. Can you provide the details with respect to the capex spend on the first phase, or the company planning to spend with respect to the first phase? And can you also repeat the estimated time of this capex being completed and the potential revenue from the first phase?
Morning, Raman. So our total investment, we've invested so far 31 crores. The total investment is 130 crores in first phase. So 99 crores is pending, which will be done between April of this year to September. And the phase will get over by, the first phase gets over by September, which is 18 million pillows capacity. So our total pillow capacity across 3 locations will go to 31 million pillows. And for the North Carolina specific facility, the revenue expectation is between $85 to $90 million US dollars, and for the utility bedding business, all put together, is $175 million.
Okay. And so my second...
sorry to interrupt you, Raman. Can you please use your handset? Your voice is a bit muffled.
Can you hear me now?
Yes, now we can hear you.
So, my last question is with respect to free trade agreement. India has recently signed FTA with UK. So, is there any plans to increase the company's presence in the UK market, because it will be, or the FTA will be advantage for Indian players when compared to other countries as well? And follow up on that, what is, if India signs FTA with the European Union, what will be the additional benefit? I just want to know in terms of, how do I say, percentage, what is the average difference between other existing players, how much percent cheaper they are able to sell, and how will that be beneficial for the company?
Sure. Our current exposure to the UK market stands at approximately 10%. With the India-UK Free Trade Agreement on the horizon, we believe that this development will provide a significant boost to bilateral trade. The FTA will allow us to operate on a level playing field with other competing countries, enhancing our competitiveness and opening up new opportunities in the region. This is a positive and strategic development for us for future growth. Also keep in mind that we have been doing business in the UK for over 15 years now, and we have an active office in Manchester, and a team there with warehousing, designing, all capabilities. So all of that gets leveraged. So we are already in active conversation. We've been selling to a lot of the customers already, and as we speak, we are already in active conversations on how do we build on this for the future. And just to add that on our current product, linen specifically, there's a tariff of 12% or an import duty of 12% from India at this point in time.
Oh, thank you, sir.
Thank you. A reminder to all participants, please restrict yourself to only 2 questions per participant. We have our next question from the line of Aditya from Synergy Investments. Please go ahead.
Yeah, good morning. Am I audible?
So you need to be a little louder.
Yeah, okay. My question is regarding the interest cost. Sir, every time there is a lot of interest cost which is taking our profits. So is there any plan in the future to reduce it? How do we go about it?
Yeah, so we are, as you know, compared to the previous year, the interest costs were a little high because we had built inventories which are required for production, higher production. We have stabilized our inventory levels at this point of time, so we feel that the the interest cost should be more or less stable around this place. But we need to note that in our US operations we are still increasing our utilization levels. So there will be some inventories build up there. So overall, I think the interest costs will be around 120-130 crores annually.
Right, sir. So we are going to go with this in the next year also, right?
Yes.
And sir, I just heard in the commentary that we expect similar performance in the Q1 also of next financial year. So, what is the guidance for revenue in this year? I understand that we are doubling our revenue by 2028, but what is the guidance for the next financial year, 1 year?
Aditya, as I mentioned earlier, in such volatile times, we are refraining from giving any guidance. Of course, our objective is to maintain our market share and then grow it even in this year.
Okay. All right. Thank you.
Thank you. We have our next question from the line of Rajesh Kothari from Alpha Advisors. Please go ahead.
Hey, hi. Good afternoon, sir. Thanks for this opportunity. I have 2 questions. One, I just wanted to understand that this tariff actually came into place, late March, and actually implementation is, of course, starting from April. And also, if I look at most other companies' results which are announced, I think by far everyone has announced the results. Nobody's reported dip in revenue, and even if there is a moderate dip, which I can understand, why there is so much significant decline in gross profit margins? Because no other companies have reported this kind of a decline. So it would be great if you can just give some details on this.
Yeah. Morning, Rajesh.
Hi.
In our case, it is an impact of change in product mix on both our raw material and fixed costs. Roughly the split is 30-70 between raw material and fixed costs, which includes both employee and other expenditure. You got to keep in mind that overall, if you look at the full year, our growth has been 16%, so that is higher than our peers. It's in the Q4 that we've seen a down trading, of within our product mix. And that's what kept our volumes to approximately 25 million plus, but our average selling price came down. And that's the reason there's an impact across the board, up to EBITDA level.
So basically, are you trying to say that, the customers with whom you are supplying to, before even tariff implementation, there was a significant down trading because tariff got implemented much later and not in month of January and February. Maybe say March, I can understand some effect probably in month of March, but otherwise, why is a drastic impact? And because if I look at on full year basis, consumer cannot shift that rapidly, am I right?
So we've seen the impact of this, lower price products in early February. However, we were not sure, this is a one-off situation or a continuing trend. It's only towards the end of February, that it was confirmed in our customer mix that this to be a continuing trend based on the order pattern from our customers. So everybody knew that tariffs are coming, so customers started, our retail customers started reacting, and we saw that from our product mix.
Understood. So do you think, in terms of your investments, what you are doing in US, this can also pose some challenge in terms of your guidance for next 2-3 years? Because a lot of investments you are planning in US. So do you see any significant change in that?
No, as I've been very clear that, we are yet comfortable with doubling our revenue by 2028. Most of our investments in the US is more or less done. It's only our North Carolina facility that needs to get completed. So we've invested 460 crores plus what we're investing in the North Carolina facility as we speak, which is approximately 99 crores of spending. So those should reap good benefits to the organization as we move forward. So we are very comfortable with where we are.
Okay, thanks. I'll come back in queue.
Thank you. We have our next question from the line of Vineet Bansal from Pinnacle Securities. Please go ahead.
Hi, thanks for posting the results. I wanted to understand a bit more about the tariffs because the previous person who asked the questions mentioned that the tariffs came in a bit late around the end of March. So given whatever tariffs are there and the kind of uncertainty, because you mentioned in the comments, because there was a lot of uncertainty because of the China tariffs and all that stuff. So I wanted to understand on that front what actually happened, what led to such a decrease in margins. You mentioned about the cost, but actually from the tariff viewpoint, and if the deal occurs between US and India, then how that might shape the prospects going forward.
Sure, Vineet. So basically, as I was explaining, that what we've seen is a down trading of products. So basically, our lower end to mid end products offtake has increased, compared to the higher end products. So that's why our product mix portfolio in Q4 has undergone a change pre-tariff, and we are seeing the same mix continue even in Q1. So our customers are not investing right now in higher end products because, of course, for them, the retail price increase will be even more substantial, and in a tough US environment, which we are in right now, there's a better offtake for more affordable products, if I may say so.
Got it. But I fail to understand why would the price increase for your products, because you're making them in the US. The tariff was 10% reduced to 10% in a few days. But Chinese products were selling at much higher tariff. Am I missing something?
Yes. This is all manufacturing that we are doing in India. So, our maximum revenue is currently being manufactured in India. We've only got into US manufacturing of pillows and quilts very, very recently from October of 2024. So that's very recent, and that's a very small part of the overall business at this point of time.
But even if you were manufacturing in India, then the tariff was around 10%, right? Or was it more?
The tariff first for India was implemented at 26%, which was changed to 10%.
Yeah.
Additional tariff from whatever import duty we have, over and above that, there was a 10% put in. It's not about only India. You see, today, if you're a customer, you're a retailer in the United States, you're not looking at only what you're buying from India or XYZ country. You're looking at how is this tariff affecting your whole product profiling. Because from China, it was 146%, the additional tariff. So it just put everything, it put the whole business on hold. And that's how the customers started picking up more value-driven products than higher-end products. That was the change.
So this is what I'm trying to understand. So the Chinese or other tariffs were much higher than the tariffs that were levied on your products. And the customers in logical sense would pick your products because they were coming at much cheaper rates, right?
It's not. You've got to look at the total basket of what they're selling within the retail store, not only home textiles or bedding or one category of products. They're looking at everything across the board and seeing how they want to manage their inventory and their order flow.
Okay. Thanks.
Thank you.
Thank you. We have our next question from the line of Jatin Damania from Swan Investments. Please go ahead.
Good morning, sir, and thank you for the opportunity. Sir, continuing the same question in terms of the revenue and the gross margin decline, can you help us in understanding the overall change in the product mix in terms of the low? I mean, how much did the fashion, utility, and contributed during the Q4, and what was the contribution of the branding in Q4?
Sure. So, Jatin, specifically the numbers right now. That over a period of time, like in any business, this is not a very large capital-intensive business, but it's a very large, very high investment on human talent and other infrastructure, including branding that we are investing in as we speak. And we've been very categorical and transparent about it.
So, sir, what is the incremental investment we will be doing in the employee and the infrastructure in FY26? Because definitely last year we did quite a few, and which impacted the margin. So, in current year, what is the incremental investment that we are going to do it?
So more or less, most of the investment has been done. Even if you see our Q3, Q4, you'll see our salary cost as stable. Now, as our third location comes up and as the utility bedding business ramps up in terms of utilization level, we'll have blue-collar workers come in and, that expense will go on, but that will be in turn with the revenue going up too, for that business. But otherwise, on the baseline, we've already created our team. Our team is in place.
Right. And on the greenfield expansion, you indicated the first phase will come in September 25. Now the 99 crores is spending. So, I mean, for second phase, what will be the capacity and how much will be spending, and when will take the decision for that?
Too early to say anything. We have a very large facility of over 300,000 square foot at that location. So we'll first, and our focus is on only utilizing the 3 manufacturing locations. As we complete that, we have enough infrastructure to expand further. Space.
Sure. Yeah, I'll come back in a queue with a couple of more questions.
Sure.
Thank you. The next question is from the line of Surya Narayan from Sunidhi Securities. Please go ahead.
Yeah, thank you for giving me opportunity. Am I audible clearly?
Yes, sir, you are.
Okay. So, Mohit sir, just one question is that a couple of questions I have. One is because we have expanded substantially in the brands and, even Vamsuta is yet to come. So, in that scenario, we understood that from the January of calendar this year, the consumer sentiment in the US has declined. So, it has been running quite weak. So how quick you see the consumer sentiment improving in this calendar, A, and number two is that because most of the brands are native to US, and when the US FTA and the US UK FTA and EU FTA will be opened up, so do you think the native brands of US that will be well accepted in those markets with that kind of let's say margin profile? So and secondly, and second point related to this only, just to understand whether the material margin in the pillows and quilts are lower than the bedding products what we were having.
Sure, Surya. So, you're asking me a multi-billion-dollar question. Can you?
Yes.
Yeah. As to when things in the US will turn around, or when demand. So our objective is very simple as an organization, is to maintain our market share, and to grow the market share. That's the objective. These are small hurdles that come along the way. We as an organization have gone through such, whether it's supply chain, whether it's COVID times, so this is one of them. These are, of course, testing times. We will get through these too. On the brand side of the business, of course, the brands that we've spoken about or have taken last year from a licensed brand and acquired Wamsutra, and we own that brand. Right now, our focus is more on the US side. Once we launch Wamsutra, the idea is to launch it as first with the halo effect, which is a direct-to-consumer on the luxury side. And then we have a lot of interest from all the retailers in the US market, to take it to them in some shape and form, which we are putting the marketing strategy around that as we speak. But our endeavor is to make Wamsutra a global home textile brand, as we've also been saying after we acquired it. But we'll take one step at a time. On your question of margins, on raw material cost, I guess in the pillow business and the quilt business is similar, to our existing business. So there the raw material is pillow shells and as well as your fiber that goes into making a pillow or a quilt.
Okay, and regarding the weak scenario or consumer sentiment scenario, so are you facing any kind of let's say jitteriness from your customers in keeping the branded goods, and it is very difficult to sustain that kind of products, and rather they are happy with only affordable utility segments, and that trend you hope will continue for another quarter or two, or maybe first half of this year?
No, I mean, the trend will continue, but we are not seeing any jitteriness when we are taking our brands to the customer. In fact, they are, very receptive, because they also want to differentiate their floor, their retail space. So if it's a meaningful brand with enough consumer data and traction, then they're happy to take it up. So there's no jitteriness that we're seeing. And of course, we are also strategic to take what to wear. It's not like one size fits all.
So where can we improve in the FY26? It is difficult to at the moment say about the guidance on the volume and the top line guidance maybe. So where can we improve? Is it the material front, or because the you are saying that the staff expenses are more or less stabilized. So we will be believing that we will be freezing the staff cost here, and other expenses are also similarly. So and depreciation may also go off a little bit because post Carolina facility, it may also go off. So where we see improvement in other line items?
Sure. So a couple of things. So of course, on our core business, which is the bedsheet business, from India that we're exporting, the objective is to maintain the market share. There are some ups and downs in the product mix which we'll have to go through. There's really not much we can do about that. Our endeavor, again, from the India bedsheet exports is to grow other markets. It's not only the US. The US comprises approximately 70% of our revenue. So other markets, geographies like EU, like UK, Japan, Australia, the Middle East. So these are all markets that are growing for us. India now has a free trade agreement, as we know, with the Middle East, with UAE specifically, with Australia and Japan. Also, when these free trade agreements, it's not a switch on and off that, it happens and then tomorrow you start shipping, right? It takes some time. So we are starting to see those benefits come in. On the U.S. business, which was U.S. manufacturing of pillows, we expect capacity utilization, which is currently at 50%, to start improving also as the quarters go by. So we are in active conversations with all our customers to grow that business, and as the new facility comes up also, that will help us grow the capacity utilization. It's impossible to put a number or to say that which quarter it will happen, but you need to have the facility and the infrastructure first and then attract the business.
Last question, if I can. Can we expect that FY24 gross margin with the help of warm sweater lunch and other branded products, we can get better than the FY24 gross margin in the FY26, FY27 at least?
Sure. At this point of time, we would not like to comment on any volume or any guidance on any numbers. It's too fluid a situation, as I mentioned earlier.
Okay, thank you. I will complete.
Sure.
Thank you. We have our next question from the line of Vaibhav from Athena Investments. Please go ahead.
Good afternoon, sir. My question pertains to the brands that we've acquired and the ones we're building in the USA. What sort of long-term margin expectations and targets have we set over the next 2 to 3 years once investments and expenses stabilize from our branded businesses?
Yeah. So, Weber, we've been saying that, once these businesses stabilize, we expect from our regular margins to do around 15 to 20% higher margin, and specifically the brand segment of the business, And overall, we maintain that as an organization, we would like to do between 16 to 17% margin across the board.
So, you'd reckon that the branded businesses will be 15 to 20% higher than the 16 or let's say 14% that you do for
because the branded business, the target is 100 million, but the revenue, if it's going to double to a billion, so it's going to be 100 on a billion, right?
Right.
So you got to keep that factor into mind.
And then the expected revenue, I think previously it's been guided between FY26 and 28 as 275 million to be the total incremental revenue. Right?
Sorry, come again, please. I didn't follow that.
I think it's been previously guided that the expected revenue from FY26 to 28 is going to be around $275 million incrementally per year, right?
Good. What we are saying is two things. Our revenue for FY25 is 4,200 crores approximately. We expect to double that by 2028. Out of that increase in revenue, 275 million will come from 2 new businesses, which is the utility bedding business, approximately 175, and 100 million from the brand business, the new brands and the like. That's the breakup.
Okay, thank you. And the last question I have is there any room to improve the working capital or the cash cycle without compromising the margins here?
Sure. So we've right now at approximately 130 days, roughly. So at this point of time, I think we should be at similar levels, keeping in mind the new businesses also. And we're always evaluating this, keeping in mind, what's the supply chain security, how do we need to service our customer. There was some increase in our Q1, Q2, which we have stabilized and brought it back.
Right. I think we'll be a bit stretched for cash since we have high interest payments and high expenses over the next year or so.
Yeah, our view is very clear that, as we're able to, we've created the infrastructure, so that's why the interest and the depreciation is on the higher side. We feel comfortable that over the next 24 months, these should get stabilized, so we should have a better pass-through from EBITDA to PAT by 150 basis points, which was the case. If you go back a year ago, you'll see roughly, that number. So it's a little bit of it's a part of the game, that we need to go through.
Okay, sir. Thank you, sir.
Thank you. A reminder to all participants, please restrict yourself to only 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. We have our next question from the line of Bhavin Chheda from NM Holdings. Please go ahead.
Good morning, sir. First, regarding the...
Sorry to interrupt you, Mr. Bhavin. Can you please be a little louder?
Hello, can you hear me now?
A bit better.
Yeah. Sir, regarding long-term guidance and the slide number 8, what peak revenue potential from new brands and the utility bidding, the $275 million increment, is it the incremental number or over the current number? And what's the current number there?
Sure, Bhavin.
Utility bidding and new brands contribute how much right now?
Correct. So Bhavin, the overall increase is 275 million. In FY24-25, that number is roughly 32 million, which is the 225 crores once I just... Yeah, sorry, it's 26.5 million, roughly 26 million odd.
Roughly 26 million, so another 275 you will add, so basically... This
No, Bhavin, the total is 275 million from a zero base.
From a zero base?
From a zero base. In 24-25, out of the 275 million, we've done 225 crores, out of which 100 crores came in Q3, 125 crores came in Q4, which translates to roughly $26 million, roughly. Yeah. So you can say 250 million will be further.
Yeah. Second question, can you give us...
Over 3 years.
Yeah. FY25 on fiscal basis, what was the geographical mix like US, UK, Europe and rest of the world?
Sure.
UK you mentioned 10%. If you
Correct.
can give US, Europe and rest of world, yeah.
US is approximately 70% for us, and then 20% is Europe, Australia, Japan, Middle East, all put together. And all those markets...
European figure separately, X of Australia, Japan and all that?
We can take that offline and give it to you. Should be 6-7%. Yeah, probably.
Non-Europe should be 6-7%, you're saying?
Yeah. We can check and give it to you offline if you don't mind.
Rough numbers. And my sir, last question. We had a Q3 call in February where you were expecting 110 to 115 million meters for full year, but you ended with 106. So I'm assuming Jan was over, Jan was fine. So whatever decline you would have seen was a sudden decline in the month of March and probably some in Feb. And continuation of that question also is, since you have mentioned in the earlier part of the call that the gross margin pressure was probably due to downgrading of product mix to the lower and the medium end, was that a client-specific issue? Your across US portfolio is seeing a downtrading, because I have not seen such downtrading happening just suddenly in 1 or 2 months tracking home textile for more than a decade. So is this a large client-specific issue or across the market?
Sure. So, we had started seeing offtake of lower priced products, Bhavin, in early February. However, we were not sure if this is like a one-off situation or a continuing trend, as I mentioned. It's only towards second half of February did we start realizing, that this seems to be a continuing trend, and this is across the US landscape. It's not specific to a retailer or a customer.
Okay. Thank you, sir. I'll come back later. Yeah.
Thank you. We have our next question from the line of Resham Jain from DSP Asset Managers. Please go ahead.
Yeah, hi, Mohitji. So I have 3 questions. First one is you explained about the ASP thing, but is there any differential in terms of the buying pattern between the big box retailers versus more fashion-led or those kind of retailers in terms of the overall demand conditions?
So Resham, of course, today we sell to a direct-to-consumer company in the US. Their product mix would be different. A big box retailer's product mix would be different. I mean, today if you're a purely a luxury store like Bloomingdale's, it would be different. So each customer is different, from their product profiling standpoint.
No, sorry. My question was, are the demand conditions right now in US, are you experiencing different behavior right now where big box retailers are doing much better and that is pulling down the overall ASP versus the more high-end or fashion-led home textile customers?
Understand. No, at this point of time, we are seeing it across the board, It's not specific
Okay.
that, let's say, a luxury store is suffering and versus, the big box is gaining traction right now.
Understood. Okay. And also, between the two sites of home textiles, Vapi and Kolhapur, how are the overall economics right now? Because Vapi, you have turned it around after taking it over, but now is the situation very different in the operating condition of both the sites? Because Vapi had its history of the past when GHCL used to manage it.
Correct. But, after 6 to 9 months of us taking it over, we had both facilities got to a similar margin profile number, So for us, there's two separate manufacturing units, servicing clients. So there's no differentiation. Even their cost patterns are very similar.
Okay, got it. And my last question is, sir, with respect to the US facilities, and there are, you're putting up greenfield also. Generally, we have seen most of the Indian companies in the past who have put up facilities in US. They typically face a lot of challenges in operating and making money. So, according to you, let's say if you have to give 2-3 pointers which gives you confidence, and these are large investments which you are doing there. So, the history is very patchy for most of the not just textile players, but most of the other industries.
Sure, Resham. So, of course, we are also privy to those, and we've also gone through, the data. But what we've done is we've, of course, invested in a very, very strong team, some of the best in the industry. We've handpicked them, chosen them, got them on board, where both us and, their thought processes completely match and tally. We've invested in 3 strategic locations, got it. Of course, 2 were acquired, and the third one is a greenfield project. We have great customer traction. That's how we got into this business. A lot of feedback from our customers to, get in and add value here. And that, along with, getting into some licensed brands, that will all help build these new categories of businesses for us. We are pretty comfortable with where we are at this point of time.
Okay, perfect. Thanks, Mohitji, and all the best. Thank you.
Thank you.
Thank you. We have our last question from the line of Prerna Jhunjhunwala from Elara Capital. Please go ahead.
Thank you for the opportunity. The first question is whether, because this downtrading in the US started only from February and it accentuated only in the later half of the quarter, do we see a sharper decline in ASPs or any further margin expansion than Q4, margin contraction in Q4 in Q1 than we witnessed in Q4?
So, Prerna, we would not like to give any specific comments on Q1 margin or overall, but we had seen, and because the environment is extremely volatile, so it would not be correct to give a margin for Q1. However, our endeavor will be to maintain, if not grow, from Q4 levels.
Okay. And are we seeing, additional volumes being sourced from India because the tariff post-July would, if there is no bilateral agreement with various other countries as well, we see a little more volumes in Q1 as compared to the rest of the year. Largely, I'm just trying to understand the consumer behavior over here, that whether they are trying to protect their inventory or trying to protect the profitability. How are they behaving right now in terms of volumes, and what are they asking you to share in terms of margins over the period?
Can you come again, because I didn't follow you completely, so I don't want to get you.
Okay, so the whole point, what I want to understand is how are retailers behaving in terms of their procurement cycle during this tough period, because at one end the consumers are down trading, so their profitability also gets hit, and